Hey, it's Richard with Matthews Wealth Management. We have our March 2022 market update video here. So these are very long videos. I've given up on trying to keep them short. There's a lot to cover. I like talking about it. It's cool to look back at it later. If you want to watch the whole thing, cool. If not, yeah, move on to something else, I suppose. But this month was interesting. If you recall, I did the February market update probably halfway through March. So it was kind of this is a much shorter time frame, but I did go back and look not only at all of March, but also first quarter, and found some good stuff here. So long video, like I said. But first thing we'll start with is a quote from Nancy Pelosi, the Speaker of the House of Representatives. When we're having this discussion, inflation, it's important to dispel some of those who say, I like how we dispel people, well, it's the government spending. No, it isn't. The government spending is doing the exact reverse, reducing the national debt. So write some good laws based on the premise there. It was interesting because the Federal Reserve was doing a study about why is it that U.S. inflation is 250% the rest of the developed world's inflation rate around the world, because we all went through a pandemic, right? But why specifically was the U.S. hit so terribly? We all have supply chain issues. But what the San Francisco Fed found in a study was, in seeking an explanation, we turned to the combination of direct fiscal support introduced to counteract the economic devastation caused by the pandemic. That's still not exactly correct. I would say the pandemic didn't do it. Our shutdowns did it, right? We chose this option. We didn't debate it. There was nobody could push back against the science of it. But because of what we thought the pandemic was going to do, and we locked everything down, and we had to pay everybody the unemployment, we had to do the PPP, and we had to spend all of this money that was doing the reverse by lowering the national debt. This is just insanity, y'all. I don't really know how to hold back like I'm supposed to here, but I guess the San Francisco Fed doesn't agree with the Speaker of the House of Representatives. But who would be right? Who's an expert? I guess that doesn't matter anymore. But we're talking now about what we're going to do about gasoline prices. And they've come down a little bit, actually, since mid-March was kind of the peak that we have seen, at least in the short term here. We're talking about gas card giveaways. That would be financed by something. I don't know. Would we print some money for that? Send the gas cards to people. That's pretty cool. We did tax holidays. A few states have already started gas tax holidays. I guess we don't need that revenue for the state. It's just weird. And then energy rebates, and we're going to make that a direct payment to taxpayers. The IRS has set up a great system to where they can directly deposit into people's accounts now. That money is created from the Federal Reserve, so digital currency, we kind of already got the stuff set up, y'all, for that. But this is just insane. I mean, you solve inflation by creating inflation, and then 10 years from now, 20 years from now, we'll be like, well, that's just the way it is. Learn this stuff, y'all. It's important. Like your standard of living is being stolen, and you're just like, oh, it's hard. I don't want to understand all of this. Wow. I might edit that part out. We'll see. Anyway, we've now decided to deplete our strategic petroleum reserve because we're not going to refill it. I guess, where are we going to get the oil to fill it back up? Or we don't need a reserve anymore. This is the last ditch. We're going to use up our oil and all be on electric cars and lithium because we got access to lots of that too. Fertilizer, wheat, corn, soybean, metals, all of that stuff is going up in price, specifically for the U.S. I wrote U.S. only here. I found that was kind of interesting because a lot of these sanctions that we've put against Russia for invading the Ukraine, it doesn't apply. France especially. My gosh, France is just kind of ignoring it. But a lot of these European countries, they literally cannot stop this importing, or they would lose population, right? I mean, people would starve, people would freeze. You can't just say, hey, they're bad, let's cut off. They've made some terrible agreements with Russia over the years that, well, we told you so, you shouldn't have done it. But now that you did, we're the only ones actually really crushing ourselves here with these sanctions. And I'll go into what that actually means, like where we're getting crushed, because we do import a lot of stuff, but there's some currency issues here too. We're seeing India, I mentioned this in the last video, India is moving very, very quickly to China and Russia. And they're doing a lot of financial deals. They're actually doing a lot of financial transactions, a lot of currency exchange work with them. India's just looking out for India. And I don't blame them. They should. I mean, that's maybe how nations should work. Who knows? All right, so without diving too much into those three, I want to jump into specifically Russia. What's going on with Russia? Russia, I think, has figured something out that the U.S. should have. We had it figured out a long time ago. We went away from it way back in the day. But this was interesting to track. The ruble, and in the last video I said rupee, ruble. That was the India and Russia thing. But the ruble, and Biden had a little pun to help you remember if you have if you need a mnemonic device. But February 24th, the ruble was 84 rubles equaled $1 US, 84 to 1, right? And I know this graph looks a little inverse. I could put decimals up there. Nobody likes decimals, so we'll keep it simple like this. I could probably flip that. Well, no, it is that, but the graph is correct. Anyway, 84 to 1 on February. We hit March 7th, and the value of the ruble had dropped. It would now take 131.2 rubles to equal $1. So the sanctions were hitting them hard, right? Well, by the end of March, we're at 84 to 1. What happened? The sanctions, what's going on? How is their economy doing so well? And this was kind of funny. March 26th, Joe Biden is quoted as saying, the ruble was almost immediately reduced to rubble. Okay, it was, but you're looking at 26 is when you said it. Were you paying attention? It was bouncing back. Do you know why it was bouncing back? I don't know. I'm not an economist, I guess. Anyway, one of the things that Russia has done to solidify their currency, number one, is come up with some good strategic economic partners, and I think we missed the boat on that. But you know, dealing with China, good luck, Russia, on that one. Y'all aren't the most reputable and transparent economies. Trying to pick the words correctly there. So good luck with that, but there is a lot of demand. There's also a lot of supply, so they are good strategic big economies if they can work well together. So what Russia did was they came up with a minimum price that they would pay for a gram of gold. We usually talk ounces, but they're doing grams and has to do with their exchange and so forth. But 5,000 rubles would buy you 1 gram of gold. Okay, so if you do, the 83 is today. What we're looking at, so actually the value of the ruble's better now than pre-Ukraine because these sanctions are so awesome. Very ironic there. 83 to a dollar means that they have backed their currency to $1,700 an ounce. Okay, today it's $1,923 an ounce. $1,923 will buy you 1 ounce of gold. That fluctuates up and down. It went over 2,000 at one point, but we're at 1923. And anyway, this is saying that they are guaranteeing at least 1,700, right, for the ounce of gold. So I'm trying to equate things. I'm trying to show you apples and apples here. So what they've effectively done is semi-backed their currency with an asset. And I mentioned this in the last 2 videos now. But that's a little troubling if you're not for Russia. I'm not for Russia, FYI. But they're using sound fiscal policy here that I wish we would do. And what it's doing is incentivizing a lot more money and economic bartering. I mean, get the concept of money out of your head and think about the economy and how this works. When they're exporting gold or natural gas or uranium or fertilizer or wheat or whatever it is that they're sending out, if they're dealing in their currency backed by gold, doesn't matter what the dollar does all of a sudden, right? I mean, we're effectively split off from that economy. And the fact that they're only taking rubles or gold in exchange for their barrels of oil, well, that's a discount right now. We talked about the arbitrage play before, and I thought the numbers were off. They're still off. We're not there yet. But if the ruble goes to 75 to 1, now we're at 1889. We're right on the actual value here. What this means is we've got to make sure that we're managing this, the value of the dollar. And with comments like that, it doesn't look good. I don't know what our odds would be. It's going to be interesting coming back to this video and seeing what happens. But odds, if you're going to make a bet on it and look for a payout, that's doesn't look good. Anyway, when this 1889 jumps past whatever current price of the dollar for gold is going to be, because we're looking at comparing three variables here. When that happens, and Matthews Wealth Management has clients invested in gold through ETFs, which we call paper gold. We're not, used to be physical, right? So they called themselves physical, but then when the Redditors, the people who were chasing all the AMC and ironic meme stocks, once all of that stuff started to hit, these prospectuses changed on the paper gold and the paper silver and the paper commodities to where they didn't necessarily have to bring in all of the physical to make it meet. And so legally, I don't know how that's allowed. I mean, honestly, that seems like a Ponzi scheme. Like, oh, we've got the silver, but we don't have it all. We got most of it. We'll get the rest. But when there's an economy that's operating out here with real valuations backed in real physical gold is what we're using here, but real physical commodities, what's going to happen to the value of those ETFs? They're supposed to represent something, but they're supposed to represent something, not just an arbitrary index, right? Like, so when you're chasing an index, okay, you may or may not hold the actual fund. So an index fund versus an ETF, it's do you actually own the thing you're tracking, right? And that's what we're getting into here. And I mean, I hate to say Russia's the one that's on the cutting edge of establishing a sound currency. And who's at risk? Well, we are, the dollar. And so then we come back over here, Saudi Arabia, with their oil, they're now going to be selling their oil in Chinese currency. So the petrodollar, we've always had the petrodollar, and that's been actually the economic backbone of our country post-World War II. Well, now the petro yuan, that's hard to say. I mean, try it. Just say it out loud. Petro yuan. But if that happens, what's going to happen to the reserve currency? Right now, the U.S. is 55%. The U.S. dollar is 55% of the world currency reserves, right? I think euro is somewhere in the 20%, and then you get into the yuan, and it's 2.3%. Well, so this is a very good representation of the valuation of an economy, right? We're a consuming economy, and China kind of is too, and Europe kind of is too. So if we're looking at kind of the same thing, China actually produces a lot more than us. When the values of those currencies shift, so does the standard of living in said economies, right? So flip it. Imagine that we're only 2.3% of world currency reserves, and China is now 55%, and they're doing all of the production. We're in big trouble with that. So we talk about inflation. Everybody looked at this gasoline thing and somehow created this weird logical fallacy link between gasoline and being bombed in Ukraine and said, well, we'll take the inflation. Okay. Well, when it hits the supermarket, you'll complain and say that it's not fair and people are making too much profit. Elizabeth Warren started that already. Then we'll talk about affordable housing, right? And so landlords, man, y'all are, good luck. Y'all are about to be really demonized by all this, when really the Fed even said it was the government that created all this money. I mean, this is why I track this stuff, is we've seen this coming. I mean, if you haven't seen this coming, you're not paying attention. There was a second half rally in March, right? So after my February video, things were actually still looking pretty down and they bounced, right? And one of the biggest things that I guess Bloomberg and CNBC cared a lot about was this 25 basis point hike, right? The Federal Reserve is going to raise the federal funds rate to 25 basis points. Yay. In the world of interest rate risk, that is a huge change from 0 to something positive. That's, you cross the 0, you go infinity. But they're now talking about another 50 basis points in May. That's a big deal. And we're seeing inversion of the yield curve, and treasuries are going to, the value of bonds is tanking. When we get to the end of this video, you'll see kind of what I'm talking about. But this does matter, right? But why in the world would it bounce back at the end of March? What's going well right now? It's not. It's inflation, right? So this gain coming here is really inflation happening again. And we're going to see in second quarter coming up earnings, right? We'll see first quarter earnings in the world of high commodity prices. And it'll be very telling as to the trajectory that we're on. But most of this rally is coming from the inflation, which is really mapping out how these currencies are playing together. And we've got tons of printing going on in the developed world. China's actually messing with their currency again, but then you have this out of left field, an asset-backed currency. So that changes things a lot. I mean, that completely undid sanctions. I would actually say Russia's got an upper hand now economically with how they're running their entire financial system compared to ours, and we don't seem to learn anything. I mean, the Fed kind of did, but are we going to do anything about it? We'll see. So we'll come back, we'll go over M2 money supply, balance sheet, that kind of stuff, and then we'll finish up with asset classes. So come right back. Okay, so M2, SL, we are currently at 21 trillion, 811 billion, $800 million in circulation. That's up from a month ago by, just under 0.5%. It's funny, I was at the coffee shop the other day and somebody asked me, how much more money was printed in the last month. So that shows a couple of people watch this, so that's kind of cool. But I was wrong. I said next to none. I thought we'd be like 0.16 or something that would reflect less printing, but that's not the case. It's actually above some of the months last year, which is surprising to me. So that's just continuing to grow up. From a year ago, last March, we are up 11% as far as inflation, debasing our currency. And from pre-lockdowns, 2020, we are up 41.57%. So that same conversation, somebody said, well, how much total inflation did you say again? And I said, probably 42%, somewhere in there. It was close, so very close. That was kind of cool. It's nice to be right on these numbers sometimes, but that's part of why I do this. It helps me keep up with it. So anyway, balance sheet is additional type of inflation. It's assets that are being bought up in quantitative easing. It's part of how we continue our debt, which comes from funding like government spending. I don't know where else we could look to sell this stuff. I guess world reserve currency stuff would be a good idea, but that's drying up. So the Fed's continued to quantitatively ease, which just means buying bonds from the Treasury, as well as buying bonds from the secondary market, usually through BlackRock, by the way. But they have increased their balance sheet by 0.29%, so they're up to 8.9 trillion. So that's kind of weird. Up from our 21 trillion, 8.9 trillion is sitting on the Fed balance sheet, and we're all worried about the price of gasoline. That's kind of strange. Like this money, where does that end up? When does that come back? I think I did the mini-series when we were down in Charleston, and the issue is inflation hits at different times depending on how it's created, when it's created, and then like when asset bubbles pop and burst. Another thing is when the Fed sells this stuff, usually cheap, right? They won't sell it dollar for dollar, but when they sell it back or somebody buys it back, this comes right back out into more currency circulating around the economy, which creates inflation, prices to go up. So, yeah, just more bad news, I guess. But it's interesting to see the relationship, right? So we got the 0.38, and we got the 0.29, 11 and 16, and then the 42 versus 114% since the pre-lockdowns in response to the virus. So, yeah, just to keep this updated, it's huge numbers, and I know people get lost in the huge numbers. Hopefully percentage speaks something to you. It does to me. If you can learn to speak and understand in percentages, you don't really need to know this. You'll inherently understand it. But yeah, I like to put all the numbers and zeros up there because then you understand this is ridiculous how much money is circulating around here and how much debt and assets the Fed's buying and storing on their balance sheet. So we'll come back with the asset classes next. All right, asset class performance. This is for the month of March 2022. Value stocks, think high dividend, cash cow, been around forever, stabilized business. Growth stocks, R&D, new business, they've got to come up with the next new greatest thing, Apple, Amazon, Tesla, that kind of thing. And then core or blend is kind of a mixture of the two different types of businesses or whatever. Somebody asked me to go through this again. I don't want to do this every video, but yeah, maybe this is helpful. large company, medium-sized company, small company. So in this month, everything looked pretty good except for mid-cap growth. I found it kind of interesting that core or blend in large cap was the biggest. This was a better distribution. This was a weird distribution. But in general, everything kind of went up, and mainly towards the end of March, into the first quarter. A lot of that's kind of tying up positions, trades, and inflation, right? It's the inflation trade all over again. Real estate rebounded up 6.5%. Oil continued up 8%. Its peak was mid-March. It did drop back down towards the end there. Gold's up 2.65%. Bonds took the big hit. A lot of this came from the rate hike, the 25 basis points, and the continuation of rate hikes going forward, 50 basis points in May, et cetera, et cetera. And this will have an effect on the yield curve and bonds in general. Sorry, I always jump to bonds when I turn this direction, but international is up. Again, that has to do with the exact same reason here. Emerging markets, though, are down, and that's back to that what we talked about in the first segment about currency, the currency situation, how everybody's printing. But short term's down 1.3, intermediate 2.5, long term's 4. That makes a lot of sense. That's kind of cool how that worked. That's a good correlation across those different types of asset classes there. TIPS down 1.86, and high yields are only down 1.1. That's surprisingly good. Not exactly sure why those high yields would only be down 1.15 unless people are just willing to take that risk. They were already paying a higher interest rate. They're going to keep the risk, and so I guess they sell less. It's a interesting thing to see there, though. S&P was up 3.71%, as we just talked about on U.S. equities. Dow Jones Moderate, though, was just barely under even, down 1 basis point. What I found really interesting here is to summarize Q1, the end of the first quarter, the typical 60-40 mix, right? Everybody's used to, I guess this would be considered the moderate to, a moderate portfolio-ish. Maybe a little more aggressive. 60% stocks, 40% bonds, was down 10% in the first quarter. And in the world of inflation, that's rough, right? You're having to pay more for stuff, and the value of your savings is dropping. Not as bad as the 50-50, which is maybe more of a traditional moderate. It kind of fluctuates between these two. But a 50-50 portfolio was down 13.6% in that same first quarter in the world of inflation. So hopefully that the first two segments add more context where this stuff just was like, duh, this is what I figured he'd throw up there on the board. But it's good to keep up with it, good to see how the numbers play out. We're thinking through another reallocation. We're rolling here into second quarter meetings starting up soon. We're going to be moving our business here within the next few months. So there's a lot going on here, but there's a lot happening on the world stage in in all of the markets, not just the stock market, but bond market, especially commodities markets. This inflation's coming. It's not even, I mean, we're maybe halfway, maybe 2/3 of the way through it, but it's still going to continue. There's a lot more to be worried about, and you know, stock up on essentials, stuff that you're going to need around the house. It's not getting cheaper. Everything right now is on sale. Think of it that way. If you don't have, you know, some food to last you and all that good stuff. But anyway, if you want to talk to us about some steps that you can take, what to do with this information, just want to chat, ask me at the coffee shop, or you know, getting a drink or lunch or something, don't hesitate to come by and talk. I love talking about this stuff. I should probably do it a lot less with all the stuff going on, but hey, this is what I enjoy. It's my passion. So anyway, we'll be here next month, and we'll see you then.